Welcome back to the Deep Dive. I hope you are sitting comfortably, and I hope you have your time travel seatbelts fastened.
Hey!
Because today, we're not just looking at a topic, we're going back to a very specific, a very strange vibe.
It was a unique moment in human history. It really
I
was.
want you to close your eyes for a second. Imagine a world where the coolest piece of technology you own is beige.
Oh, yeah.
It weighs about 50 pounds. It makes a screeching, static noise when you try to talk to the world.
That's the one. The song of the dial-up modem. The handshake.
Exactly. And I want you to imagine a level of financial optimism that, when we look back at it now with 2020 hindsight, looks less like investing and more like a collective hallucination.
It was a mass delusion of a very expensive party that everyone, and I mean everyone, thought would never end.
We are talking, of course, about the dot-com bubble.
Or the dot-com boom.
Or, if you want to sound like you work on Wall Street, the TMT bubble.
TMT tech, media, and telecom.
Which I think is actually a better name for it, right?
Yeah.
Because .com makes it sound like it was just about websites.
Right, and that's a crucial distinction to make right at the top. When people remember this era, they think of the sock puppet.
Pets.com.
They think of Pets.com. They think of websites selling dog food or groceries or, beanbag chairs. But the bubble wasn't just the storefronts.
No.
It was the entire infrastructure. It was the media companies, the telecommunications giants laying the cables, the hardware makers building the routers. I mean, it was the whole ecosystem of the future.
It was the pipes, the content, and the delivery trucks.
Exactly. It was a synchronized mania across three massive sectors.
So, to set the scene for the listener, I want to transport you to a very specific date. If you have a mental calendar, put a big red pin in Friday, March 10th, 2000.
The peak, the absolute top of the mountain.
On that specific Friday, the NASDAQ Composite Index hit 5,048.62. Now, if you're not a finance person, that number might just sound like a number. But the vibe on the street was pure euphoria. Everyone felt rich. If you had money in the market, you weren't just a saver, you were a genius.
You were picking winners, and the thing is, it felt like you couldn't pick a loser. Everything was going up.
But to understand just how high that mountain was, we have to look at the climb. Because mountains don't just appear overnight.
No, they don't.
Between 1995 and that day, in March 2000, the NASDAQ didn't just double, it didn't just triple, it rose by 600%.
600% in 5 years. Just let that sink in for a second. Imagine your house value going up 600% in 5 years.
Unimaginable.
Right. If you bought a house for, say, $200,000, 5 years later it's worth $1.2 million, you'd feel pretty good about yourself.
You feel unstoppable. You'd probably buy a boat.
You buy 2 boats. And that's basically what America did.
It's staggering. It defies gravity. But, as the old saying goes, what goes up
must come down. And usually much faster than it went up. Gravity is a harsh mistress in the financial markets.
By October 2002, so just 2.5 years later, the NASDAQ had fallen 78%.
78?
It didn't just correct. It gave up all its gains. 5 years of wealth creation just evaporated.
And that is usually where the story stops for most people. The standard narrative is people got greedy, they bought stupid stocks, the stocks crashed, everyone lost money, the end.
Right. It's a morality tale.
It is. It's treated like a fable about greed.
Or don't buy hype. Don't quit your day job to day trade. All of that.
But our mission on this deep dive is to go a lot deeper than that. We want to understand the mechanics of the machine. We want to look at the convergence of technology, psychology, and this is the big one. People miss government policy.
The invisible hand of the government. Or maybe not so invisible.
Exactly. We need to see how those three things combined to create this moment of what one investor called temporary insanity. And perhaps more importantly, we need to answer the big, provocative question, was it all a waste?
That's the question that really stuck with me reading through the research. We see the trillions of dollars lost, but did we actually get anything for it? Or was it just lighting money on fire in a dumpster?
It's a fascinating trade-off, because if you look at the brokerage accounts of the year 2002, it's a tragedy. It's ruined retirements, lives changed for the worse.
Yeah.
But if you look at the cables in the ground, the servers in the racks, the code that was written, you might actually see the foundation of the modern world.
So let's unpack this. Let's start at the beginning. Part 1, the perfect storm.
Yeah.
Because this didn't just happen out of nowhere.
No.
You don't wake up one day and decide to value a company that sells nothing at $1 billion. There were ingredients that had to come together to bake this very expensive cake.
Right. You need a catalyst. You need a spark.
Yep.
And in this case, the catalyst was a fundamental technological shift, a huge one.
We have to talk about Mosaic.
Yes, 1993, the Mosaic web browser.
For the younger listeners, or even those who just forgot,
Yeah.
because tech moves so fast before Mosaic, what was the internet? What did it even look like?
It was ugly. It was text. It was a green screen or a black screen with white text. It was for academics, the military, maybe some really hardcore hobbyists who knew how to use command lines.
Not for the average person.
Not at all. It wasn't friendly. It was a tool for sharing research, not a place to hang out or shop.
It was a utility, not a destination.
Perfect way to put it. But then in 1993, you get the release of the Mosaic web browser. And suddenly the internet has images.
Picture.
It has buttons you can click with a mouse. It has color. It has a back button. It became visual.
It gave the internet a face.
And that changed everything because it made the web accessible to regular human beings, not just computer scientists. It was the moment the internet went from being like radio to being like television.
And the adoption rates, they just reflect that shift completely. I was looking at the data here, and the jump is wild. Between 1990 and 1997, the percentage of households in the United States that owned a computer jumped from 15% to 35%.
That is a massive societal shift in less than a decade. I mean, think about it. You went from the computer being a luxury item.
A hobbyist thing.
Yeah, something maybe a wealthy person has in the den next to their telescope, to a household necessity, like a fridge or a TV. Parents felt like if they didn't get a computer, their kids would be left behind in school.
And this brings up that concept of the digital divide reducing. We're seeing the birth of the information age right before our eyes.
And whenever you have a shift to a new economic era, I mean, think about the shift from farming to factories or the invention of the railroad or electricity, you have a rush of capital.
Right.
Investors smell a paradigm shift.
They don't want to miss the boat.
They don't want to miss the boat. They know the world is changing, and they know the people who own the infrastructure of that change become the new robber barons.
Yeah.
But in the late 90s, it wasn't just fear of missing out. It was policy fuel.
Right.
The government wasn't just watching from the sidelines. They were actively pouring gas on the fire.
This is the part of the research that surprised me the most. I always thought of the bubble as just crazy investors doing crazy things.
Yeah.
But the government set the table.
Oh, they set the table, cooked the meal, and served the drinks. In a few key ways. First, you had the Taxpayer Relief Act of 1997.
Okay, taxpayer relief sounds boring. It sounds like something you hear on C-SPAN and fall asleep. Why was this huge?
Because it lowered the top marginal capital gains tax in the U.S.
Okay, break that down. ELI 5, that for me. What does that actually mean for someone sitting at home?
Okay. So let's say you buy a stock for $10 and sell it for $100. You made a $90 profit. That's a capital gain.
Yep.
The government wants a cut of that $90. Before 1997, they took a bigger cut up to 28%. After 1997, they cut it down to 20%.
So if I make money betting on stocks, I get to keep more of it. Simple as that.
Precisely. And what does that do to your psychology as an investor? It incentivizes speculative investment. If the penalty for cashing out is lower and the reward is higher, you are more willing to take a risk on a high-growth, unproven stock. You are willing to bet on the future.
So the government basically said the casinos are open and the house is taking a smaller cut.
In a way, yes. And then you have to look at the cost of the chips, the cost of borrowing money.
Interest rates.
Interest rates were declining, capital was cheap. If you can borrow money for next to nothing, you aren't going to keep it under the mattress.
No.
You aren't going to put it in a savings account earning 2%. You're going to invest it. You're going to chase yield.
So we have low taxes on winnings and cheap money to bet with. A potent combination.
And then the third leg of the stool, we have the Telecommunications Act of 1996.
This is the one that really impacted the infrastructure side, right? The pipe.
Huge impact. That act was the regulatory green light. The expectation was that it would unleash a wave of new technologies and competition. It basically told the telecom companies, go out there and build, compete, lay fiber, connect America.
It created a gold rush mentality to profit from building the actual physical internet.
And everyone wanted to own the pipes. Because the logic was, I don't know which website will win, but they all need the internet.
It's the classic selling shovels in a gold rush strategy.
Exactly. Except everyone started selling shovels, and suddenly you had 1 billion shovels and, well, not enough gold.
Now, there is a name that comes up a lot when we talk about this era. A man who was basically the wizard behind the curtain. Alan Greenspan.
The chair of the Federal Reserve. The maestro, as Bob Woodward called him.
He is often quoted as warning about irrational exuberance. I feel like that phrase is on his tombstone. He said it in a speech in 1996.
He did. He asked, "How do we know when irrational exuberance has unduly escalated asset values?" It was a warning shot. But the market ignored him, and frankly, the sources suggest his role was a bit more complicated than just being the guy ringing the warning bell.
How so?
Well, it's debated, but some argue he actually fueled the investment frenzy later on. There's this idea that by putting a positive spin on stock valuations, or at least not aggressively popping the bubble early on with rate hikes, he gave the market a false sense of security.
The Greenspan put.
Right. In finance, a put option protects you from a drop in price. The Greenspan put was this psychological belief held by traders that if things got too bad, the Fed would step in and cut rates to save the market.
Like a safety net.
Exactly. Dad will bail us out. So if you believe the risk is limited because the Fed has your back, but the upside is unlimited because of the internet, what do?
You bet the house.
You bet the house. So you have this perfect storm. A revolutionary technology, a computer in every third home, low taxes on profits, cheap money, and a regulatory environment that says build, build, build.
It's no wonder people went a little crazy.
It would have been weird if they didn't go crazy. The incentives were perfectly aligned for mania.
Which brings us to part 2, the new economy mindset. This is where the psychology really takes over.
The mania.
Because looking back, the math just did take it. It doesn't work. I remember looking at companies back then, even as a kid, and hearing adults talk about these businesses. They don't make any money, but they're worth billions.
Yeah.
How did people rationalize that? How do you look at a balance sheet full of red ink and say, take my money?
Because that was the old economy thinking. You see, in the new economy, profits were considered, well, almost a liability.
A liability. How can making money be a bad thing? That sounds like the opposite of business.
It sounds insane, but follow the logic, okay? If you were making a profit, it meant you weren't reinvesting enough in growth.
No.
It meant you were being conservative. And in a land grab, you don't want to be conservative.
I want to capture territory.
Exactly. If you have a profit margin, it means you charged too much and didn't acquire enough customers.
Right.
The metric wasn't price to earnings or PE. That was for, Ford and Procter & Gamble. That was for boring businesses.
Right. Traditional metrics were just thrown out the window. PE is for losers.
Just look at the PE ratio of the NASDAQ at the peak. It reached 200.
200. Okay, break that down for me. What does that even mean?
It means that for every dollar of profit these companies made, investors were paying $200 for the stock. Essentially, at that rate, assuming earnings stayed flat, it would take you 200 years to earn back your investment.
That is optimistic.
It's beyond optimistic. It's theological. It requires faith.
Wow.
To put that in perspective, let's look at the Japanese asset bubble of 1991. That was famous for being massive. The grounds of the Imperial Palace in Tokyo were rumored to be worth more than all the real estate in California.
Right, massive bubble. I remember that.
At the peak of that bubble, the PE only reached 80.
So the dot-com bubble was 2.5 times more expensive relative to earnings than the Japanese bubble.
That is the definition of insanity. And it wasn't just the index. It was specific stocks. I mean, look at Qualcomm.
Oh, Qualcomm, the chip maker.
In 1999 alone, a single year, Qualcomm shares rose 2,619%.
2,619%. So imagine putting $1,000 into Qualcomm in January, maybe your holiday bonus, and having over $26,000 in December.
You'd feel like a genius. You'd quit your job. You'd tell everyone at the bar how smart you are.
And it wasn't just one outlier.
No, there were 12 other large cap stocks that rose over 1,000% that year. It seemed easy.
And the secret sauce seemed to be the name.
The magic suffix.
The dot-com.
It was like magic dust. Investors were eager to throw money at anything with an internet prefix or a .com at the end. There were studies done on this. You could take a boring mining company, change the name to mining.com or e-mining, and the stock would pop.
Just for the name change. No business change.
Just for the name. No change in business model. Just the signaling that we get it. It was like painting racing stripes on a turtle and calling it a race car.
But there was a logic to it, right? I mean, smart people were doing this. Venture capitalists, hedge funds. It wasn't just random gambling. There was a business strategy driving this valuation.
Yes. The strategy was get big fast. Or sometimes get large or get lost.
It sounds like a threat.
It basically was. The theory was based on network effects. The idea that the value of a network goes up as more users join. Think about a fax machine.
Right.
One fax machine is useless. 2 are okay, a million are indispensable.
If you're the only one with email, who are you emailing?
Exactly. So the goal was to grab as much mind share and market share as possible immediately. You wanted to be the standard. You wanted to be the verb. You wanted people to say Google it, although Google wasn't public yet. You wanted to be the Amazon of whatever. Pet food.
And how do you do that?
You spend massive amounts on advertising. You sell your product for free or at a deep discount. You accept huge net operating losses.
So you lose money on every sale, but you make it up in volume.
You make it up in future dominance. That was the theory. The thinking was, once we own the market, once we are the only pet food store online, then we can raise prices. Then we can turn on the profit tap.
Oh.
But first, we have to kill the competition with cash. We have to scorch the earth so no one else can grow.
It's a war of attrition. I can bleed longer than you can.
It is. And that cash was being spent on more than just customer acquisition. The lifestyle of the dot-com era is legendary.
Dot-com party.
It became a symbol of the excess. Companies that had never made a dime would throw these lavish launch parties. Open bars, celebrities, expensive offices in the best parts of town.
The beanbag chairs, the foosball tables.
And the Aeron chair. We have to talk about the Aeron chair.
I feel like the Aeron chair is the unofficial mascot of the bubble.
It really is. That Herman Miller mesh chair. It cost over $1,000, and suddenly every startup with 3 employees and a domain name had 20 of them.
Why that chair? What was the deal with that?
It became the throne of the dot-com CEO. It was about projecting an aura of invincibility. We are the new economy. We play by different rules. We don't sit in stuffy leather chairs like the old bankers. We sit in a high-tech mesh. We are the future.
It was a status symbol.
A huge one. And the marketing madness, I think it really reached its peak at the Super Bowl.
The Super Bowl is always a good barometer of where the loose money is.
Oh, yeah. If you want to know who has too much cash, look at the commercials.
Exactly. In January 2000, for Super Bowl 34, dot-com companies bought between 12 and 19 of the 61 available ad spots.
That's almost a third of the Super Bowl, and these spots cost, what, like $2 million for 30 seconds back then?
Roughly. So you have companies, again, with little to no revenue, burning millions on a 30-second spot.
Right.
You had E-Trade, you had Monster.com, and you had Pets.com.
And just to show you how quickly the tide turned by January 2001, the next Super Bowl.
How many?
Only 3 .com spots.
Wow. From taking over the broadcast to barely existing in 1 year. And we can't talk about ads without mentioning the sock puppet.
Pets.com, the poster child of the bubble.
A very cute mascot, a very recognized brand. People love the puppet. He was everywhere. He was on Good Morning America, wasn't he?
He was, but the business.
The business.
The business model involved shipping heavy bags of dog food across the country via FedEx.
Which is expensive. Dog food is heavy.
It's incredibly expensive, and they were selling the food for less than it cost to buy and ship it.
Wait.
Yes, it was the ultimate example of get big fast, without a plan to get profitable ever. Every time someone bought a bag of dog food, Pets.com lost money.
So the more successful they were at marketing, the faster they went broke.
Precisely. They were marketing their own suicide.
And while the companies were doing this, the regular people, the retail investors, were eating it up.
This was the era of the day trader. It was unprecedented. Before this, stock trading was for guys in suits on Wall Street. Now, you had stories of people quitting their steady jobs, doctors, lawyers, factory workers, to sit at home and trade stocks on their bulky PCs.
Because it seemed easy. You buy in the morning, it goes up 10% by lunch, you sell. Why work a 9 to 5?
And the media played a huge role in this. CNBC became the background noise of America. They reported on the market with the suspense of a sports event. It was play-by-play action, tickers scrolling, flashing red and green.
It validated the mania. If it's on TV, it must be real. Even the Wall Street Journal, the bastion of financial conservatism, ran an article suggesting that investors should rethink the quaint idea of profits.
When the Wall Street Journal calls profits quaint, you know you are in a bubble. That's the sign. It's like a doctor calling a heartbeat optional.
Absolutely. Now, I want to pivot to something that often gets overlooked in this story. We focus so much on the websites, the Pets.coms and the eToys, but there was a massive bubble happening underneath them. Part 3, the telecom bubble.
The invisible backbone. You can't have a website without the pipes to deliver it.
And the investment here was even bigger than in the sock puppets.
Oh, much bigger in terms of hard assets. We talked about that 1996 Telecom Act. In the 5 years following that, telecommunications equipment companies invested over $500 billion.
$500 billion. That's $500 billion in 5 years.
In fiber optic cables, switches, wireless networks, they were digging up streets in every major city. They were laying cables across the Atlantic and Pacific Oceans.
I remember seeing the spools of orange conduit everywhere on the side of the road. It felt like the whole world was under construction.
Yes, that was the physical manifestation of the bubble. And most of this was financed with heavy debt.
They were borrowing billions to dig holes. Why? What was the logic?
They were betting on a specific statistic. There was a widely circulated myth, a report that came out claiming that internet traffic was doubling every 100 days.
Every 100 days. That's massive exponential growth.
That was the claim. If that were true, within a few years, the entire population of the Earth wouldn't be able to generate enough data to fill the pipes.
But it wasn't true.
It was true for a very short period in the mid-90s, but then it slowed down significantly. But the companies built their models as if it would double every 100 days forever.
So they were building a 10-lane highway for a dirt road's worth of traffic.
Exactly. They were building for 2010 demand in 1999.
And just like the dot-coms, government saw dollar signs here too, specifically with spectrum auctions.
Right. This is where companies bid for the rights to use radio frequencies for mobile phones.
The airwaves.
Exactly. Specifically for 3G, the third generation of mobile data. In the UK, in April 2000, the government held an auction for this spectrum. It raised £22.5 billion.
That is a staggering amount of money for thin air.
Literally thin air. Radio waves. And in Germany, in August 2000, it was even higher, £30 billion.
These telecom companies were spending billions just for the permission to operate before they even built a single tower.
It was the winner's curse. To win the auction, you had to overpay. If you didn't win, you were out of business because you had no spectrum. If you did win, you were saddled with so much debt you might go out of business anyway.
Damned if you do, damned if you don't.
Precisely. But the U.S. had a bit of a hiccup with this, didn't they?
A massive failure, actually.
Yeah.
A 1999 auction had to be rerun because the winners defaulted on $4 billion worth of bids.
They bid money they didn't have.
He simply couldn't pay.
That should have been a warning sign, a huge flashing red light.
It should have been. But the party was too loud. No one could hear the warning. The problem was simple supply and demand. The telecom companies built enough capacity for a future that was 10 years away, not 2 years away. Supply vastly outstripped demand.
And when the crash came, who got hurt the most?
The bond investors.
Yeah.
The people who lent the money for all this infrastructure.
Right. Not the stockholders, the debt holders.
Yeah. They ended up recovering only about 20% of their investments.
Ouch. So we have the tech mania, the telecom debt bomb, and then we reach the summit, part 4, the peak and the smart money.
March 10, 2000. NASDAQ 5,048.62.
Right. But there was a moment just before that in January that really signaled the peak for a lot of people, the AOL-Time Warner merger.
The deal of the century. Announced January 10, 2000. It was the largest merger to date. What was it, a $350 billion combined value?
Something like that. It was enormous.
You had AOL America Online, the new money internet service provider, the company sending those CDs to your mailbox every week.
And they were buying Time Warner, the old media giant. Movies, magazines, cable news, Warner Brothers. An institution.
It felt upside down, the upstart buying the giant.
At the time, the true believers saw it as the ultimate victory of the internet. The new economy was literally swallowing the old economy. AOL was using its inflated stock currency to buy real assets.
But skeptics saw it differently.
The smart money looked at that and said, this is the top.
Why? What was the signal?
Because when the bubble company buys the real company, it's usually a sign that the bubble company knows its stock is overvalued. They want to cash it in for something tangible before the music stops.
It's like if I have a winning lottery ticket that I know is fake, but I trade it for your house before you figure it out.
That is a perfect analogy. AOL knew their stock price was fantasy. They wanted to trade that fantasy paper for Time Warner's real assets, copyrights, cables, studios.
And speaking of cashing in, let's talk about the insiders. Because while retail investors were buying, the people inside these companies, the ones who saw the books, were itching to sell.
But they couldn't always sell immediately, right? There were lockup periods.
Right. What is a lockup period?
Usually after an IPO, an initial public offering, employees and founders have to wait, often 6 months, before they can sell their shares. It's to prevent the stock from crashing on day one from everyone selling.
So they were paper millionaires. They could look at the screen and see they were worth $10 million, but they couldn't buy a sandwich with it. Not yet.
Correct. And this created a predictable pattern that some very smart investors exploited.
Enter Sir John Templeton.
A legendary investor. He was in his 80s at this point. He looked at this market and called it temporary insanity. He saw a once-in-a-lifetime opportunity.
To make money on the way down.
Exactly. What was his strategy?
He shorted dot-com stocks just before the lockup periods expired.
Shorting means betting the price will go down.
Yeah. He correctly predicted that as soon as that 6-month window opened, the insiders, who knew the company wasn't making any money, would rush to dump their stock to buy houses and cars.
He was betting on human nature. He knew the employees would want to cash out their lottery tickets.
And that flood of selling would crash the price. And he made a fortune doing it. He made, what, $86 million in a few months betting against the bubble?
And he wasn't the only one getting out. Mark Cuban,
The famous entrepreneur. He sold Broadcast.com to Yahoo for billions in stock. But he didn't just hold the Yahoo stock, did he?
No, he knew Yahoo was overvalued too.
So he entered into hedges, specifically collars, to protect his gains. He essentially locked in his billion-dollar status regardless of what the market did. If Yahoo crashed, he was safe.
Smart. And then you have the telecom execs, the guys building the pipes.
Philip Anschutz sold $1.9 billion worth of stock.
$1 billion.
Joseph Nacchio, $248 million. Gary Winnick, $748 million.
They were selling hundreds of millions of dollars worth of stock before the crash.
Which tells you everything you need to know about what they thought of their own valuations. If they believed the hype, they would have held on. They sold.
So the smart money is heading for the exits, the insiders are waiting to dump, the timeline is ticking, and then the triggers start to pull. Part 5, the burst.
It wasn't one single thing. It was a cascade, a death spiral.
It started in March 2000. First, there was Y2K.
Remember Y2K, the millennium bug?
Everyone thought the computers were going to crash at midnight on January 2000. Planes falling out of the sky, toasters attacking people.
Right. So companies spent billions upgrading their systems in 1998 and 1999 to prevent this.
Yeah.
They bought new servers, new software.
And then nothing happened.
And nothing happened, which was great for society, but bad for tech earnings. Once the clock struck midnight, that spending stopped. It fell off a cliff.
Because they had already bought everything they needed.
Exactly. Suddenly, tech companies saw their orders dry up. They had pulled all their future revenue into 1999.
Then, on March 13, news broke that Japan had entered a recession.
That triggered a global sell-off. It made investors nervous. The global economy wasn't as bulletproof as they thought.
Then, exactly 1 week later, March 20, Barron's Magazine publishes a cover story.
Burning up. That was the headline.
The article warned that internet companies were running out of cash fast. It analyzed the burn rate of 207 internet companies.
Then what did they find?
They predicted that 51 of them would run out of cash within 12 months. It was a splash of cold water in the face of the market. It basically said, the emperor has no clothes and also no cash.
And on that same day, MicroStrategy,
a huge high-flyer software company. They announced a revenue restatement.
Which is a polite way of saying
They admitted to aggressive accounting practices. They had been booking revenue they hadn't actually earned yet.
took in the books.
Essentially, their stock fell 62% in a single day.
Wow.
From $333 down to $140.
62% in a day. That shatters confidence. Because if MicroStrategy is lying, who else is?
Exactly. The trust evaporated, and the hits kept coming. April 3, the Microsoft case.
Judge Thomas Penfield Jackson.
He ruled that Microsoft was guilty of monopolization and violation of the Sherman Antitrust Act.
This is the titan of tech. If Microsoft can be broken up by the government, no one is safe.
Microsoft shares dropped 15% in a day. The NASDAQ dropped 8%. The whole sector got hit.
And then the final nail in the coffin. And this is the one that really hurts to hear about. Tax day, April 14, 2000.
This is the tragic irony of the bubble. This is where the retail investor really got crushed.
Explain this dynamic, because it's just cruel.
In 1999, people made massive capital gains. They sold stocks. They made millions on paper or in cash. They felt rich.
But by April 2000, the market was sliding. Hard.
But they still owed taxes on the gains from 1999. The IRS works on a calendar year.
The IRS doesn't care that you lost money in March 2000. They want their cut of what you made in December 1999.
Right. So imagine you made $100,000 in 1999. You owe the government maybe $20,000, but you reinvested that money into the market in January because you thought it would go up forever. By April, that $100,000 is now worth $10,000.
But you still owe the government $20,000.
But you still owe the government $20,000. Exactly. You are mathematically insolvent. You are bankrupt. And to pay the tax bill, investors were forced to sell their crashing stocks.
Selling begets selling.
It creates a downward pressure, Everyone is rushing for the exit at the same time to pay Uncle Sam.
which caused the market to crash even further.
On that Friday, April 14th, the Nasdaq fell 9%. It ended a week where it fell 25%.
A quarter of the value gone in a single week.
And that was it. The death spiral really set in. Capital dried up. No one wanted to invest anymore. The metric shifted from how many eyeballs do you have to what is your burn rate?
Burn rate. How fast are you dying?
Exactly. How many months until the cash runs out? And for many, the answer was not many.
Tets.com.
Gone. 9 months after its IPO, it was out of business.
Webvan, Boo.com, WorldCom, Northpoint Communications, Global Crossing.
Bankruptcies everywhere. By November 2000, internet stocks were down 75%. $1.755 trillion in value was wiped out.
And the big guys weren't spared either. Cisco.
Cisco Systems, which was briefly the most valuable company in the world, lost 80% of its stock value.
80%. Imagine owning the safest stock in the sector. The guys making the routers and losing 80%.
It was total devastation.
Which brings us to part 6,
Yep.
Aftermath and Legacy. When the smoke cleared, what was left?
Well, there were casualties. Real human casualties.
The job market for programmers collapsed.
There was a glut of office equipment. We mentioned the Aeron chair earlier.
Right.
After the crash, you could pick up an $1,100 Aeron chair for pennies on the dollar from liquidators. It became the symbol of the failed startup.
And university enrollment in computer-related degrees dropped noticeably. People thought tech is over. It was a fad.
Can you imagine thinking computers were a fad? But that was the sentiment. The internet thing didn't work out.
And then came the scandals. When the tide goes out, you see who is swimming naked.
Oh, yeah. Enron in October 2001, WorldCom in June 2002, which was the largest bankruptcy ever at the time. Adelphia.
Executives like Bernard Ebbers, Jeffrey Skilling, Kenneth Lay, they were accused and convicted. It turned out a lot of that new economy magic was just old-fashioned fraud.
But, and this is the crucial but, the reason we are doing this deep dive, not everyone died.
No. In fact, a surprising number survived.
48% of dot-com companies actually survived through 2004. They were battered, their stock prices were crushed, but they were still in business.
Amazon.eBay, and a little company called Google, which actually gained market share during this time.
The market shifted from fragmentation, thousands of little startups, to consolidation. A few giants emerged to dominate the landscape.
And this leads us to the bright side, the theory by venture capitalist Fred Wilson.
Fred Wilson is a legend, and he lost 90% of his net worth in the crash, so he earned the right to have an opinion on this.
What does he say?
He quotes a friend who says, "Nothing important has ever been built without irrational exuberance."
That is a powerful line. Nothing important has ever been built without irrational exuberance.
It really is. The argument is that you need a mania. You need investors to go a little crazy to open up their pocketbooks wide enough to finance massive infrastructure projects.
Like the railroads.
Exactly. In the 1800s, we had a railroad bubble. Investors lost everything, but the tracks remained. Or the automobile industry, or in this case, the internet backbone.
So all that money that was lost, the $5 trillion, it didn't just disappear into a black hole.
No, it went into the ground. It went into laying fiber optic cables. It went into building server farms. It went into developing software and databases.
And when the companies went bankrupt, that infrastructure didn't disappear. The cables stayed in the ground.
Exactly. The investors lost their shirts, but society kept the shirt. We got a high-throughput backbone for the internet, essentially for free, paid for by the speculative mania of the late 90s.
That is such a fascinating way to look at it. The investors subsidized the modern world.
They did. The cheap bandwidth we enjoy today, the ability to stream video, it's all running on the surplus capacity built during the bubble. They built the highway, went broke, and we are driving on it for free.
So as we wrap up, let's recap the cycle. We had the hype fueled by new tech like Mosaic and easy money from the Fed. We had the overinvestment, the get big fast madness. We had the crash, the pain, the bankruptcies, and finally the utility that remained.
It's the classic boom and bust cycle, but accelerated to internet speed.
And for you listening, the learner, why does this matter today?
Because human nature doesn't change. We see bubbles forming all the time. Look at the See Also section of our source material. It points to the AI boom happening right now. It points to cryptocurrency.
The patterns are the same. The this time is different mentality. The fear of missing out.
The question you should ask yourself when you see these current manias is, Is this irrational exuberance building something useful?
Right. Is it just gambling, or is it funding a railroad? Is it building a bridge to nowhere or a fiber optic cable to the future?
Exactly. Even if the current AI companies go bust, will the models and the chips they are building change the world? In the case of the dot-com bubble, the answer was a resounding yes.
That is the final provocative thought I want to leave you with. Was that $5 trillion loss actually a necessary donation to build the future? Or was it just pure gambling?
I think it was a bit of both. But we are the beneficiaries of the gamble.
We certainly are. Thank you for diving deep with us today. It's been a wild ride through the late 90s.
Always a pleasure.
We'll see you on the next deep dive. Keep learning.